Welcome back to the Profitable Mindset Podcast, everybody. Today we're talking about something super important for anyone who wants to make smart moves in the market. Calculated choices, balancing risk and reward. And it's not about being totally fearless, it's more about really understanding and managing that risk so you can get those rewards.
Right on. Yeah, it's kind of like a mental chess game,
Right.
You got to have that solid strategy, but also be able to think ahead, like what's your opponent going to do? Except in this case, it's the market, right?
Exactly.
And mastering that whole mental game, that can make all the difference, like between winning or totally wiping out.
No kidding. I mean, fear and greed can really throw you off, even with a good strategy.
Oh, yeah. Been there. That's why having a solid decision-making process, like a system, is key. It's like rules or a checklist to keep you objective, disciplined,
Makes sense.
Think about it. You wouldn't build a house without a blueprint, right?
Nope, definitely not. You got to have a plan.
Right. But even with the best plans, we've got to watch out for those sneaky cognitive biases, like the mental shortcuts our brains take that can sometimes, lead us down the wrong path.
Oh, totally. I catch myself doing that, like with confirmation bias. When I think a stock is a winner, I kind of ignore any bad news about it.
You've all done it. That's why it's so important to look for those opposing viewpoints, challenge yourself, be honest with yourself intellectually, you know what I mean?
Yeah, for sure.
Now, switching gears a little, let's talk about risk. Many people, they see it as something to avoid at all costs, but in reality, risk is like the fuel for potential reward.
Interesting way to put it. So higher the risk, higher the reward then.
To a point, yeah. But it's not just about chasing risky investments blindly. You got to know your own risk tolerance, how much risk you're okay with. Then align your investments with that. Take volatility. It can be scary when the market drops, right? But long-term investors, they see those drops as chances to buy good stuff at a discount. Volatility is normal, part of the cycle. It's like surfing. You don't want to get wiped out by the big wave, but you need ways to surf, right?
I like that analogy. So how do we learn to ride those waves without, wiping out?
Good question. One way is diversification. Instead of putting all your eggs in one basket, you spread your investments across different assets, sectors, different parts of the world. So if one does bad, the others cushion the blow.
Like a safety net.
Exactly.
Yeah.
Another way is hedging, using things like options, futures contracts to offset potential losses, like insurance for your investments.
So diversification, hedging, two ways to manage that volatility. Anything else we should know?
Oh, absolutely. One that's really relevant today is the risk-reward ratio. It helps you figure out if a potential trade is worth the risk, quantify it.
Okay, break that down for me. How do we actually calculate that?
Simple. You take the potential profit of a trade, divide it by the potential loss. Let's say a trade could make you $300, but you could also lose $100. That's a risk-reward ratio of 3-to-1.
Got it. So a higher ratio means more potential reward for the risk you're taking.
Exactly. And here's where it gets interesting. A good risk-reward ratio can make a strategy profitable even if you don't win most of the time.
Wait, really? How's that possible?
Imagine a strategy that only wins, say, 40% of the time. Doesn't sound great, right?
Not really.
But if your average risk reward is 3-to-1, meaning you're trying to make $3 for every $1 you risk, those wins more than cover the losses.
Because even though you're winning less, the wins are bigger.
Exactly. It's not just about winning every trade, but managing risk, maximizing the wins, Speaking of maximizing, another key ingredient is patience. It's the secret weapon that separates the good investors from the rest.
I've heard that. Patience is key, especially when it comes to investing. But it's harder than it sounds, right? We live in a world where everyone wants everything right away.
It's true. Overnight success stories everywhere, but real wealth, it takes time and discipline. Like Warren Buffett, one of the most successful investors ever. He's all about long-term value. Doesn't chase fads, just invests in companies he believes in, holds them for the long run.
Yeah, that's where compounding comes in.
Right, you got it. Compounding's like a snowball rolling downhill. Starts small, but it picks up more and more snow, grows exponentially. The longer you let it roll, the bigger it gets. It's like magic, but it needs time, that patience.
So resist that urge to get rich quick. Focus on steady growth over time.
Exactly. And that's where knowing your financial goals comes in. Saving for retirement, house down payment, kids' education, knowing what you're working towards helps you stay focused when things get bumpy.
Makes sense. So we've talked about diversification, hedging, risk-reward ratios, patience, but what about concentrating your investments? I've heard that putting more eggs in fewer baskets, so to speak, can lead to higher returns.
Yeah, it's true. Concentration is about focusing on a smaller number of assets that you really believe in, have the highest potential. It can pay off big, but also higher risk.
Like swinging for the fences then. High risk, high reward.
Exactly. It's an approach often used by more experienced investors, those who really understand a specific sector or market. They're willing to take that extra risk for the potential of a huge return.
So how do we know which is right for us? Diversification or concentration?
It depends, honestly. Your situation, risk tolerance, your goals, and your time horizon. For someone just starting out or closer to retirement, diversification is usually safer.
Building that stable foundation.
Exactly, but for someone with, more risk appetite, a longer time horizon, maybe specialized knowledge in an area, concentration might make more sense. They're willing to go for those big wins.
So not a one-size-fits-all situation. It's about knowing yourself and aligning your approach.
Exactly. And there's also a hybrid approach. The core satellite portfolio, it combines both diversification and concentration.
Oh, that's interesting. Tell me more about that.
So the core, which is like 70–80%, that's your diversified investments, providing stability, a base for growth. The remaining 20–30%, that's your satellite, where you focus on specific ideas, sectors you're really confident in that have more potential.
You're getting the best of both worlds then.
Exactly. Stability of diversification plus the potential for those higher returns from the concentrated satellite investments.
I like that. Now, let's get back to that mental game we talked about earlier. Fear and greed can really lead to bad decisions. How do we build that emotional discipline, stay cool under pressure, make those calculated choices?
The million-dollar question, right? Emotions can hijack us so fast, especially when money is involved. But there are things we can do to cultivate that discipline.
Like what? I'm all ears.
Well, having a clear plan is huge. Like a roadmap for your goals, risk tolerance, entry and exit points, and especially your risk management rules.
So you make those decisions ahead of time when you're thinking clearly, not in the heat of the moment.
Exactly. Another thing is setting realistic expectations. A lot of people come in wanting to get rich quick, and when that doesn't happen, they get discouraged, start making impulsive moves.
It's about understanding success takes time, patience, discipline.
Absolutely. And managing your screen time. Staring at prices all day can make you anxious, tempt you to overtrade.
Oh, I've been there. It's an emotional roller coaster, watching those numbers go up and down.
Easy to get sucked in. But stepping back, detaching from the constant information flow, that can do wonders for your mental state and your decision-making.
So having a healthier relationship with the market, not letting it consume you.
Right on. And mindfulness, meditation. Even a few minutes a day to calm your mind, focus on your breath. It helps you stay centered, make more rational choices, like training your mind to handle stress better.
Okay, so we've covered the mental game, managing risk, different approaches like diversification and concentration. But aren't we missing something? Data. Data is crucial for making informed decisions, isn't it?
Absolutely. Data is your best friend in trading and investing. It's like a secret weapon, helping you understand trends, asset values, find potential opportunities.
Okay, so how do we use that data to our advantage?
There are three main types of analysis traders and investors use: technical, fundamental, and sentiment.
All right, break those down for me. What's technical analysis?
Technical analysis looks at past price data volume to find patterns and trends that might predict what the market will do next. Traders use charts, indicators, all sorts of tools to try to guess where prices are headed.
So like looking for clues in the path to predict the future.
Exactly. Like a detective, looking for those signs that give you an edge. Now, fundamental analysis, that's different. It's about the intrinsic value of an asset, looking at financial statements, industry trends, economic data, all kinds of stuff to figure out if an asset is overpriced or underpriced.
So understanding the underlying value of a company, not just its price movements.
Exactly. Like looking under the hood of a car before you buy it, You want to make sure it's worth the price. And finally, sentiment analysis. That's about gauging the mood of the market. Are investors feeling bullish or bearish?
So taking the market's temperature, basically.
Exactly. You analyze things like social media trends, news sentiment, investor surveys to get a feel for the overall psychology of the market.
Interesting. So technical looks at price patterns, fundamental looks at underlying value, and sentiment tries to understand those emotional drivers.
You got it. And the really powerful thing is combining them all to get that big picture view.
Like having 3 different lenses to look through, each one giving you a different perspective.
Exactly. And with today's tech, we've got so many tools to help us analyze that data better than ever before. Charting platforms like TradingView, they let us visualize trends and patterns, while platforms like Bloomberg Terminal give us real-time financial data for fundamental analysis.
It's amazing how much data we have access to. But with so much information, it can be overwhelming, right? How do we avoid that data overload?
That's a good point. Data overload is a real thing. It can lead to analysis paralysis. The key is to be selective. Focus on the data that really matters to your strategy and your goals.
Don't try to do everything at once. Focus on the key stuff.
Right. And having a clear decision-making framework helps you stay disciplined, avoid getting sidetracked by irrelevant stuff.
Like a filter to separate the good stuff from the noise.
Exactly. And data is a tool, not a crystal ball, right? It helps you make better decisions, but it doesn't guarantee success.
Right. It's still up to us to interpret the data and make those choices.
For sure.
Yeah.
And that's where experience, intuition, a good understanding of the market all come in. Speaking of powerful tools, let's talk about leverage. It can multiply your potential gains, but it also multiplies the risk.
Okay, leverage can be tricky. Can you explain it? What is it exactly and how does it work?
Sure. Leverage is basically using borrowed money to increase your position in the market. So you control more assets than you could with just your own money.
Like boosting your buying power.
Exactly. Say you have $1,000 and want to buy a stock trading at $100 per share. Without leverage, you buy 10 shares. But with leverage, say 2-to-1 leverage, you control $2,000 worth of stock, so you buy 20 shares.
So you're doubling your buying power. But what's the downside?
The downside is that leverage magnifies both gains and losses. If the stock goes up, you make more. But if it goes down, you lose more.
A double-edged sword. Powerful for experienced investors, but dangerous if used recklessly.
Right, not for beginners. You need a deep understanding of risk management and a solid plan.
When is leverage appropriate then? When should we avoid it?
Leverage can be good when you're really confident in a trade and comfortable with the risk. Like, if you're a seasoned trader with a proven track record and you spot a high probability setup, you might use leverage to boost your profits. But for beginners or anyone with low risk tolerance, it's best to avoid it completely.
Not a tool for everyone then. Like giving a teenager who just got their learner's permit a sports car. Probably not going to end well.
Exactly. It's important to increase your leverage slowly as you gain experience, and always have a risk management plan.
Now, what are some examples of these leveraged instruments?
There are a few, each with their own quirks and risks. Margin trading, futures contracts, options, leveraged ETFs, CFDs. It's important to understand these fully before using them. Do your homework.
So leverage can be used effectively, but it's not for everyone. Like any powerful tool, you need to know how to use it safely.
Exactly. Respect the power of leverage. It's not a shortcut to riches. It's a tool that can boost your returns if you use it wisely, with careful consideration of the risks.
That's a great point. Now let's shift gears and talk about losses. No matter how good you are, losses happen. What matters is how we deal with them.
You're absolutely right. Losing is part of the game. Successful traders and investors, they turn those losses into lessons.
How do we do that? How do we learn from those mistakes?
First, analyze the loss objectively. Was it a bad strategy, emotional decision, just bad luck?
So understanding the root cause is key.
Exactly. Then you come up with strategies to prevent those same mistakes. Did you lack discipline and stray from your plan? Did you fail to manage risk properly? Or were you just on the wrong side of a trade that nobody could have predicted?
Turning those aha moments into action.
Exactly. And a trading journal is super helpful here. Write down your trades, your thinking, the outcomes. It helps you spot patterns, areas to improve.
Like a record of your trading journey and the lessons learned.
You got it. Like having a coach who helps you analyze your performance, find ways to grow. And speaking of coaches, don't be afraid to get feedback from mentors, peers, online communities. An outside perspective can give you insights you might have missed.
Like having a sounding board to help you think things through.
Exactly. And remember, losses don't mean you're a failure. They mean you're learning and growing.
Part of the process.
Exactly. The key is having a growth mindset, seeing challenges as chances to learn. Which brings us to building a resilient strategy, one that can handle the ups and downs of the market.
Okay, a resilient strategy. Sounds like something we all need. How do we build one?
A resilient strategy is adaptable, risk-managed, and data-driven. It can weather the storms and evolve as things change. Imagine a tree that bends in the wind but doesn't break.
I like that. So what does it mean for a strategy to be adaptable?
It means you adjust your approach based on the current market. Markets are constantly changing, going through bull markets, bear markets, and everything in between. A resilient strategy works in all of them.
So you have different strategies ready to use depending on what the market's doing.
Exactly. You might have a core strategy, your go-to, but then you have others for when things shift. For example, in a bull market, you might be more aggressive, taking more risks to capitalize on the upswing. But in a bear market, you might get defensive, focusing on protecting your money and minimizing losses.
So adaptability is about being flexible, responding to change. What about risk management? We've touched on it. How does it fit into a resilient strategy?
Risk management is probably the most important part of any strategy, especially a resilient one. It's about protecting your money so you can stay in the game long term.
And we've talked about some key risk management strategies, right? Like position sizing, stop loss orders, and diversification.
Exactly. Position sizing is about how much you risk on each trade. Stop loss orders are like safety nets, automatically getting you out of a trade if it goes bad. And diversification, as we talked about, spreads your risk.
Multiple layers of protection to minimize losses.
Precisely. And it's about understanding your risk tolerance, having realistic expectations for your returns.
It's about finding the right balance between risk and reward for you.
Exactly. And finally, a resilient strategy is data-driven. You use data to make smart choices, to test and refine your approach.
So data is the fuel that powers the strategy, giving you insights and guiding your decisions.
You got it. By analyzing data, you can spot trends, assess opportunities, and make those calculated choices we've been talking about.
And technology has made data analysis so much more accessible, powerful.
Absolutely. We have incredible tools and platforms to analyze data in ways we couldn't have imagined just a few years ago.
Exciting time to be in the market with all these advancements. But at the end of the day, technology is just a tool. It's the human element, critical thinking, risk management, sound decision-making that really matters.
Couldn't agree more. It's that combination of knowledge, skill, discipline, and a bit of intuition that separates the winners from the losers.
Speaking of winning and losing, let's talk about exits. Knowing when to get out of a trade is just as important as knowing when to get in.
Absolutely. Your exit strategy determines whether you lock in profits or let small losses turn into big ones.
It's where the rubber meets the road, right? All the analysis, the risk management, but ultimately, your exit decides if you make money or lose money.
Exactly. Having a clear exit strategy helps you stay disciplined, avoid emotional decisions in the heat of the moment.
Okay, so let's talk about the different types of exits. We have profit-taking exits, stop-loss exits, time-based exits, to name a few.
Right. Profit-taking exits are all about locking in gains when your position reaches a certain target, your profit objective. This could be based on your risk-reward ratio, technical levels, or even a trailing stop-loss approach.
So having a plan for taking those profits, not letting greed take over, and watching those gains disappear.
Exactly. Then we have stop-loss exits, which are crucial for managing risk. These are predetermined levels where you automatically get out of a losing position to limit your losses.
Stop losses are your insurance policy. They protect you from those big losses that can really hurt your portfolio.
Exactly. They remove emotion from the equation, making sure you exit a trade before it spirals out of control.
And then we have time-based exits, often used in short-term trading. Like if you're a day trader, you might close all your positions by the end of the day.
Right. Time-based exits help you manage risk by limiting your exposure to overnight or weekend market volatility.
Now, when setting profit targets, there are different approaches. Can you walk us through some of them?
Sure. One common way is to use your risk-reward ratio. So if your ratio is 1.3, meaning you risk $1 to potentially make $3, you would set your profit target at a level that gives you that 3.1 return.
So the potential reward matches the risk you're taking.
Precisely. You can also use technical levels like resistance levels, Fibonacci extensions, or even psychological price points.
Right. Those levels often act as points where the price might stop or reverse, so they're good places to consider taking profits.
Exactly. And then there's the trailing stop loss, a more dynamic approach. As the price moves in your favor, you adjust your stop loss accordingly, locking in profits as you go.
So letting your profits run while still protecting yourself from a reversal. A great way to maximize gains in trending markets.
Exactly. It's worth exploring, especially if you're comfortable actively managing your positions. Now, let's switch to the other side. Managing losses. Cutting losses is just as important as taking profits, wouldn't you say?
Absolutely. Failing to cut losses is a huge mistake traders and investors make. It's usually driven by emotions like hope, fear, or not wanting to admit they were wrong.
It's that I'll just hold on a little longer, it'll come back, thinking. But sometimes it doesn't, or it keeps dropping. And those losses get bigger and bigger.
Exactly. Like hoping a sinking ship will somehow float again. Sometimes you gotta accept the loss and move on.
Precisely. And that's why stop-loss orders are so important. They force you to exit when the price hits a certain point, preventing small losses from becoming huge ones.
Stop losses are your emergency brake. They can save you from a lot of pain.
Exactly. And remember, position sizing matters too. Keeping your positions relatively small limits the impact of any one loss on your entire portfolio.
Don't put all your eggs in one basket.
Right. It's about spreading your risk, making sure one bad trade doesn't wipe you out. For long-term investments, it's also crucial to look at the fundamentals again periodically. If the reasons you originally invested have changed, it might be time to sell, even if you're losing money.
You don't want to hold on to a loser just because you've already invested time and money. Sometimes the best move is to cut your losses and find better opportunities.
Exactly. Like holding a stock that's going nowhere. You're missing out on potential gains elsewhere.
So we've talked about setting profit targets and managing losses. But what specific indicators or signals can help us time those exits?
There are a lot of technical indicators that can give you clues. For example, the Relative Strength Index, RSI, can help you see if an asset is overbought or oversold, which could mean the price is about to reverse.
So if the RSI shows overbought conditions, it might be a good time to take profits.
Exactly. Moving averages can be helpful too. If the price drops below a key moving average, like the 50-day or 200-day, it could mean the trend is weakening. Time to exit a long position.
Those moving averages act like dynamic support or resistance levels.
Exactly. And volume analysis can provide valuable insights as well. If you see volume dropping during an uptrend, it could mean the momentum is fading. A reversal might be coming.
Like the market's running out of steam.
Exactly. And then there are Fibonacci levels, often used to identify potential retracement or extension points in a trend.
Right, Fibonacci levels can tell you where the price might find support or resistance.
Exactly. And lastly, the average true range, ATR, can be used to adjust your stop-loss levels based on the current market volatility.
So the ATR helps you adjust your risk management to the current market conditions, making sure your stop losses are in the right place.
Precisely. It's like adjusting your sails based on how strong the wind is.
These are great tools and techniques for exits, but no indicator is perfect. It's always best to use a combination of indicators and your own analysis to make those decisions.
Absolutely. Use the tools as a guide, but also trust your gut and your understanding of the market.
Now let's talk about exit strategies for different trading styles. Scalpers, day traders, swing traders, and trend followers each have their own unique ways of exiting trades.
Right. Scalpers, for example, go for very small profits, getting out of trades within minutes, even seconds. They use tight stop losses and rely on high volume to make money.
Speed and precision. In and out of trades super fast.
Exactly. Day traders, on the other hand, hold positions for a few hours or the whole day, exiting before the market closes to avoid overnight risk. They often use technical indicators and price patterns to time their entries and exits.
Trying to ride those intraday price swings, the volatility within a single trading session.
Precisely. Swing traders usually hold positions for a few days or weeks, trying to capture those bigger price swings. They often use a mix of technical and fundamental analysis to find trades, and they use wider stop losses to handle the larger price movements.
Like catching a wave and riding it for as long as it lasts.
Exactly. And lastly, we have trend followers who aim to capture long-term trends that can last for months or even years. They use trailing stop losses to let their profits grow while also protecting themselves from reversals.
Like surfing those big market trends all the way up or down.
Precisely. Now let's shift gears and talk about exit strategies for investors who usually have longer time horizons than traders.
Okay, so investors are playing a different game. Their exit strategies depend on different factors.
Exactly. Investors usually have longer time horizons, and their exit strategies often focus on fundamental factors rather than technical signals.
Right. They're, after long-term growth, not so worried about those short-term price fluctuations.
Exactly. One common exit strategy for investors is valuation-based. They sell when an asset hits or goes above its intrinsic value, which they figure out through fundamental analysis.
So they sell when the price doesn't match the underlying value anymore.
Exactly. And then we have earnings-based exits, where investors sell if a company's earnings slow down or don't meet expectations.
Right. Earnings drive stock prices, so it makes sense to exit if earnings aren't good.
Exactly. Another common strategy is portfolio rebalancing. Investors periodically adjust their holdings to maintain their desired asset allocation ratios. So if one asset class does really well, they might sell some of those holdings and invest in other asset classes to rebalance their portfolio.
Right. Managing risk and making sure one asset class doesn't become too big a part of their portfolio.
Exactly. And finally, investors might exit if there are big changes in the company or asset's fundamentals, like changes in management, industry trends, or the competitive landscape.
So understanding when the reason they originally invested isn't valid anymore.
Precisely. It's important to stay updated on those changes and adjust your portfolio accordingly. Now, let's talk about common mistakes people make when exiting trades or investments.
I'm sure we've all made those classic exit blunders.
Yeah.
What should we watch out for?
One common mistake is getting out too early because of fear. Traders or investors might see a small profit and get scared of losing it, so they sell too soon.
Right.
Yeah, that fear of missing out, right? But you can miss out on even bigger gains if the trend keeps going.
Like taking a cookie out of the oven before it's done.
You get a taste, but you miss the real deal.
Exactly. Another mistake is holding on to losers for too long, hoping it'll turn around, not wanting to admit you're wrong, or even thinking the market's wrong. Been there, done that, holding on to that sinking ship. But as we talked about, sometimes you got to cut your losses and move on.
For sure. Sometimes the best trade is the one you don't make, or the one you get out of early to save your money for something better.
And I used to overcomplicate exits. So many indicators and rules, I'd get stuck and miss good opportunities.
Too many ingredients in the recipe, you just order takeout.
Exactly. A clear exit strategy is good, but not so complex that it's a burden.
Keep it simple, something you understand and can do consistently.
Now, any tools or techniques to help us manage exits better?
Automated orders are really powerful. You tell your broker to execute a trade when certain things happen.
So like a stop loss to automatically sell if the price drops too low, or a take profit to sell when it hits your target.
Exactly. Automated orders take out the emotion, make sure your trades happen according to plan, even when you're not watching.
Like a robot trader working for you 24/7, catching those key exit points?
Precisely. Another helpful thing is alerts and notifications. Set them up on your platform or with your broker to tell you when prices hit certain levels or when certain events happen.
So you can stay informed without staring at the screen all day. Like a personal assistant saying, hey, that stock you're watching just hit your price.
Exactly. You can go about your day, and the alerts keep you in the loop. And then there are analytical tools, too. Performance analytics software tracks your trading history and analyzes your past trades, including how you entered and exited.
It's like a supercharged trading journal. You can see all your wins and losses, average win-loss size, win rate, and so much more.
Right. It helps you spot patterns in your trading, shows you where you can improve your entries, exits, your whole strategy even.
And then there's scenario testing. You can simulate different scenarios and see how your strategy would work under different market conditions.
Like a time machine for trading. Test different approaches without risking real money.
Exactly.
Try different entries and exits, position sizes, risk management techniques. See what works best for you and your style.
These tools are amazing, but they're just that, tools. The key is understanding the markets and having the discipline to follow your plan.
You got it. Technology helps us make decisions, but it can't replace our knowledge, judgment, and emotional control.
Speaking of emotional control, let's get back to the mental game. We've talked about it, but it's so important.
Absolutely. Trading and investing are as much about psychology as they are about analysis and strategy. Our minds can be our best friend or our worst enemy.
That inner voice, always talking. Sometimes it's helpful, sometimes it leads us astray.
Exactly. We have to learn to manage that voice, quiet the fears and doubts, boost the confidence and clarity.
So, practical tips for mastering the mental game.
First, a solid trading or investing plan. Write down your goals, risk tolerance, strategies, risk management rules.
It's like a compass for the market. Keep you focused, helps you avoid impulsive decisions.
Exactly. And equally important, realistic expectations. Trading and investing aren't get-rich-quick schemes. They take patience, discipline, willingness to learn from both wins and losses.
It's about the journey, not just the destination.
Exactly. Celebrate your wins, but don't let them go to your head. Learn from losses, but don't let them get you down.
Part of the process.
For sure. Another tip, manage your screen time. Staring at prices all day makes you anxious, leads to impulsive decisions.
Like watching a horror movie. You know you shouldn't look, but you can't help it. Then you have nightmares.
Exactly. Choose specific times to check the market. Stick to your plan. Don't let the market run your life.
Makes sense.
And mindfulness, meditation, a few minutes a day to calm your mind, focus on your breath, find some inner peace. It can really improve your performance.
So we've talked about having a plan, realistic expectations, managing screen time, and mindfulness. Anything else to strengthen that mental game?
Yeah, it helps to have a supportive community, traders, investors, a mentor, a coach, people to talk to, share ideas with, learn from. It makes a big difference.
It's like a pit crew for your trading journey, keeping you on track, helping you adjust, cheering you on.
Exactly. And if you're struggling with anxiety, fear, any emotions that affect your trading, don't be afraid to get professional help.
No shame in asking for help. It shows strength.
Absolutely. Now let's talk about something else. Continuous learning. In trading and investing, it's so important.
Absolutely. The market's always changing. New tech, new strategies. If we don't keep learning, we fall behind.
Like surfing, you got to adapt to ride the waves.
How do we stay ahead of the curve then?
There's so much out there. Books, articles, podcasts, online courses, webinars.
It's like a library at our fingertips.
Exactly. Don't be afraid to try new strategies, but be careful, manage your risk.
Like learning a new sport. You'll make mistakes, but that's how you learn and grow.
Right. And track your progress, analyze your results, see what's working and what's not.
Always improving?
Exactly. Now let's talk about building a strong foundation of knowledge and skills.
You can't build a skyscraper on a shaky foundation.
Exactly. You need to understand the basics of trading and investing, asset classes, types of analysis, trading styles, risk management.
Like learning the alphabet before you can write.
Exactly. Then you can build on that foundation, develop your own style.
Finding what works for you, your personality, your risk tolerance, and your goals.
Exactly. There's no one right way to trade.
Now, what about finding a mentor?
A mentor can be so valuable. Guidance, support, accountability, a fresh perspective.
Like a Sherpa guiding you at Mount Everest. They've been there, know the way, can help you avoid the dangers.
Exactly. A good mentor can save you years of struggle, help you learn faster.
Now, what about a growth mindset?
A growth mindset is essential, especially in this field. Embrace challenges as opportunities to grow, learn from your mistakes, always try to improve.
Believing you can always learn and grow no matter how much experience you have.
Exactly. See setbacks as temporary, not permanent.
And celebrate your wins, but don't get complacent.
Right. There's always more to learn, always room to get better.
We've covered a lot. Continuous learning, building a foundation, finding a mentor, having a growth mindset. What else is essential for success?
I think knowing your why is crucial. Why are you trading or investing? Your goals, what are you trying to achieve?
Having a purpose can be really motivating, especially when things get tough and you want to quit.
Exactly. It's your North Star, guiding you through the dark.
And it's not just about the money, right?
Of course not. It's about financial freedom, security, independence, creating a better life for yourself and your family.
Having the resources to do what you love, travel, give back, or just spend more time with loved ones.
Exactly. Living life on your terms.
We've covered a lot today. Risk management, data analysis, the mental game, continuous learning.
We looked at different types of exits, common mistakes, and the tools that can help us in the market.
We talked about mentors, growth mindset, and defining your why.
A full journey through calculated choices and balancing risk and reward.
I hope our listeners found it helpful and empowering.
I hope so too. Now, as we wrap up, let's leave our listeners with some final thoughts. Remember, trading and investing aren't about getting rich quick. It's about having a solid plan, managing your risk, making calculated decisions based on data.
Right.
It's about embracing the journey, learning from your experiences, and constantly trying to improve.
And finding your own path to success.
Exactly. Keep learning, keep growing, and keep those profits coming in.
Yeah, this has been great. So many insights and practical tips. Really covered a lot from the mental side to managing risk to those exit strategies.
Definitely a deep dive into making smart choices, that balance between risk and reward, giving listeners the tools to approach the market with confidence.
Absolutely. So as we wrap up this episode of the Profitable Mindset Podcast, any key takeaways our listeners should remember on their own trading and investing journey?
Well, remember, success in the market, it's a marathon, not a sprint. You got to have patience, discipline, that long-term view.
Don't get caught up in the hype, right? Focus on those goals, your strategy, and managing your risk.
The market's always going up and down, but over time, it generally goes up. So stay focused, ride those waves, think big picture.
And it's not just the numbers. The mental game matters too, right?
Huge. Manage your emotions, stress, expectations.
Right.
Don't let fear or greed make your decisions for you. Stick to the plan. Make choices based on data, not your gut feeling.
Makes sense.
And don't be afraid to mess up. We all do. It's part of learning. Embrace those setbacks, figure out what went wrong, use it to get better.
Losses aren't the end of the world. They're chances to grow.
Exactly. Learn from them, adapt, keep moving forward. And speaking of growth, having that growth mindset, that's key.
Yeah.
Believe in yourself, that you can learn and improve. Always look for new knowledge, challenge yourself to try new things.
Step out of that comfort zone.
Exactly. Find a supportive community, a mentor or coach to help you, and never stop trying to be better.
Always reaching for that next level.
Exactly. And most important of all, enjoy the ride. Trading, investing can be tough, but they can also be super rewarding. So find that joy in what you're doing, celebrate those wins, and never forget why you started in the first place.
This has been awesome. So many insights, so much to think about. Really appreciate you sharing your knowledge and expertise with us.
My pleasure. Hope our listeners got a lot out of it.
And to all our listeners out there, best of luck on your trading and investing journey. Remember, stay informed, stay disciplined, and stay profitable.